so they're less concerned with market volatility and can focus more on the things they're passionate about. Talk with your advisor about Shield annuities from Bright House Financial, established by MetLife.
This is Bloomberg Markets, The Open. I'm Kaylee Lyons here in the Hewlett-Packard Enterprise Green Room. Coming up on Bloomberg Markets, Ilan Goldfein, Banco Central de Brazil president.
Crude price is getting a nice boost this morning. WTI at one point topping $69 a barrel, climbing more than 6% since its lows on Tuesday. The touching its highest point in more than 3 years. Those moves coming on the heels of a surprise drop in U.S. inventories, added to signs the market is in balance heading into a key OPEC meeting today, where some say that they could see a balanced market in the second quarter of this year. Well, joining us now from Philadelphia is Stephen Schork, Schork Report editor, and Mike McGlone of Bloomberg Intelligence. And still with us is Gina Martin-Adams of Bloomberg Intelligence as well. Mr. Schork, explain to me the reasoning. OPEC says Q2 they see a balanced market, yet they're going to continue to cut until 2019. I don't get it.
Yes, actually, because they are talking the market up, and I really want to reiterate here that it is based on faulty economics. What you hear out of Saudi Arabia is their need for $80 oil to maintain a standard of living. That's not market economics. So we're talking about a situation where they want to continue to pay their bills, their extravagant living, as well as juice the books for the Aramco IPO. So I think at this point, Saudi and OPEC and Russia want to keep oil in that sweet spot, and that sweet spot is $65 to $75 a barrel. At that level, oil producers can still make a living. They can still pay their bills, and also at that level, and this is more important, that the consumer will not balk at these prices at the pump.
But I thought that the price we were watching was 50 to 65, and all of a sudden now it's re-rated. So the question winds up becoming, why would investors trust that? And why would equity investors want to buy energy equities and trust that the rally could be sustained?
Oh, they shouldn't want to buy it here because oil prices at the current levels, 65.70, excuse me, that 55.65, that's more of the NYMEX WTI price, which completely different economics given the rapid growth of production here in North America. That 65 to 75 is more of a global market, more of the Brent market at this point. So at that point, I would say, and I listened to a previous guest estimating about 10% of this price is too high, and that is based on geopolitical factors right now. Of course, we have the looming Iran sanctions, the renewal thereof, situation in Syria, the lousy situation in Venezuela. So there is, for the first time in a long time, a significant geopolitical risk. So as we approach $80 as an equity investor, I would be wary of that. And as I said, I think oil and keep it down in that $70 range is a more comfortable, more realistic price target.
Mike, you look at the chart. Are we up for a breakout, or are we at a top?
These are levels I'd have to agree with Steve here. It'd be nice to have some disagreement, but at 70 in WTI, that's like the magic level. From the peak in 2011 to the bottom 2016, that's the halfway mark. And it's very unlikely we can sustain them above there without good geopolitical news. And like Steven mentioned, OPEC's getting it right. I mean, they have the marketing down. They're talking up the market. But from a market that bottom, it was about a year ago, around 42, we've had a pretty substantial rally. Now I think it's towards the end of the sweet spot in that rally. You got to be real careful here.
So, Gina, in the equity market, it's all been about the underperformance of energy stocks, full stop. What happens now?
Well, I mean, they've outperformed by 1,100 basis points over the last month. I mean, I think a lot of this, frankly, is energy stocks have been very restrained. Sentiment, I've never seen sentiment this negative toward a sector in my life.
Really?
I mean, it's just extraordinary. I don't meet a single investor that likes energy stocks. Everyone tells you you should sell. Everyone tells you that the oil price gain is not sustainable. If it's not that, then it's environmental, social, and governance issues that the energy companies face, right? There's always a lot of excuses why to sell energy. So a lot of what's happened is we had energy in this sort of sideways trading range for multiple months. And I have a chart that I brought with me if we happen to be able to show it. A lot of what I think has happened over the last month is this sector has just caught up with oil prices. It was just deny, deny, deny. Oil prices are not going to go above 60. It's over for oil for months and months. And then suddenly over the last month, it's really shot higher to try to catch up.
Right, but if Stephen and you have Mike both seeing sort of the peak, and we see more downside, if you're an equity investor, you bought into that, you're going to get hurt again?
You could, except there's one big contingency, and that is this catch-up has not driven revisions on revenues yet. When you look at the earnings lines, the analysts too are skeptical that this oil price can maintain this level. So we have not seen earnings revisions positive in the energy sector. I'm sorry, we've not seen revenue revisions positive in the energy sector, which you would almost always see on an oil price move from $60 to $70. Instead, all of the revisions have come to the bottom line. So they're tax related, maybe cost cut related. If you get any sustainability of the price of oil, you're going to see revenue revisions start to move higher. And what we've seen on the index over the last year or so is revenue revisions actually drive growth. Analysts and investors are constantly looking for top-line consistency. They're looking for ex-tax consistency. So if you get any sustainable oil price range, even $65 to $70, is enough to keep those revenue revisions potentially moving higher. That's the thing that I would watch for. I mean, I think, frankly, sentiment is so low in this sector, there's still a tremendous amount of upside if you can sustain oil prices at higher levels.
All right, Stephen Schork, great to get your perspective of the Schork Report. Always good to catch up with you on commodities. And I want to pivot also to the other commodity complex that we're watching, and that's industrial metals. You held Alcoa moving higher as well after they reported earnings and say that they now see a deficit of about $1